Okay, so now we're going to introduce a topic we haven't spent much time on yet, which is insurance. Obviously, a big factor in your overall financial standing is what sort of health insurance you choose, and also whether or not you choose to use life insurance. Before we get into the specifics, I want you to understand what insurance does. Because what I see is a lot of people get life insurance just because they think that's something they're supposed to do. So I think it's good to have a conception of what insurance is really trying to accomplish for you. So let me give you an example so that you see how it works for you and why companies are willing to offer it. So let's imagine in an example here that we have 5 people that are climbing a mountain. And it's really risky. Climbing this mountain, let's say it's Mount Everest. It's very risky. You could get extremely injured, okay? And let's say that somehow we know exactly what the risks are, okay? And what we know is exactly 1 out of 5 will face $50,000 in healthcare expenses, okay? So if 5 people decide to hike the mountain, exactly 1 of them is going to get really injured and face $50,000 in healthcare expenses. And obviously you don't want to be the person that experiences those healthcare expenses, but you don't know if it's going to be you or someone else, okay? So essentially this is the situation that you're in, all right? If you're one of these people hiking, you've got a 20% chance of losing $50,000. And you've got an 80% chance of losing nothing, right? That's your 2 possibilities: lose $50,000 or lose $0, right? And so your expected loss here is $10,000. If we do the math, we'll see that the expected loss there is $10,000. So on average, you'll lose $10,000 if you could somehow climb this mountain millions of times. Of course, you're not really going to lose $10,000. There's only 2 options. You're either going to lose $50,000 or 0. And so what we have here is substantial risk, right? If this is your expected amount you lose, there's a lot of risk associated with that potential loss. What we call this sometimes is downside risk. The risk is very large in the worst case scenario, okay? So what might end up happening is that an insurance company offers full coverage for $12,000, okay? The insurance company offers full coverage for $12,000. So you can pay $12,000, and in the event that you're the one who gets very injured, you'll only lose $12,000 because the insurance company is going to provide you with all of your medical expenses covered, okay? So let's think about why you might do it, and let's think about why the insurance company might do it. Well, if everyone decides to buy this company, or rather decides to buy this insurance, the profits for this insurance company is going to end up being $60,000 minus $50,000 or $10,000 in profit, okay? Now, where did I get that number? All right, well, if the insurance costs $12,000, if that's your insurance premium, and everyone decides to pay it, so all 5 of these people pay $12,000, the insurance agency is going to get $60,000 in revenues, right? And of course, only 1 person is going to get injured. So only 1 person, they have to pay $50,000 in medical expenses. So the insurance company here is bound to gain $10,000. Now let's think about it for you, okay? For you, what this does is it changes the game. Rather than having substantial risk where you either are going to lose $50,000 or lose nothing, now you know how much you're going to lose. You're going to lose $12,000. Regardless of whether you're the one who gets injured or not, it's going to cost you $12,000 in insurance premiums, okay? If you get really injured, they pay for it. If you don't get injured, well, it costs $12,000. So you can see why you might be willing to make this decision, right? You might be willing to make this decision because basically you don't want the risk. So what there is to recognize about insurance is available to you to reduce risk, especially when the risk is very large, okay? I'll sometimes see people, at Walmart and stuff getting insurance on their blender. They buy a blender and they say, would you like to buy insurance for $5? We'll cover you in case the blender breaks. And people will buy that insurance. That's usually kind of not reasonable because the risk is so small that you shouldn't be willing to give up money to avoid that risk, okay? In this example, the reason this would probably seem like a good deal to you is because that $50,000 is going to be like life-changing loss, right? If you're the one who gets injured, that $50,000 could be like a big deal to you. So when the downside risk, when the potential losses are really large, that's when insurance makes the most sense, okay? So just to change this example, imagine if we're only talking about losing $50 here, okay? In this case, the insurance company might offer you insurance for $12. Well, I would argue that in this scenario here, it's probably not worth it for you to buy the insurance because the risk is so small, you shouldn't be willing to pay extra money to avoid it, okay? So keep that in mind. Insurance is about covering you when the risk is very large, all right? Remember that insurance is a negative expected win for you. Companies that offer insurance are trying to make money. So when you're buying insurance, you're usually buying something that's a bad deal for you. So you only want to pay it when you know that the risks are so large that you really would like to avoid that risk. And so there's two types of risks, or rather two types of insurance that we're going to discuss. Life insurance and health insurance. What you will see is life insurance and health insurance often offers different options, and it's important that you understand these options. Health insurance, if you're watching this video, you need health insurance, right? Going without health insurance is basically impossible unless you're like a billionaire, okay? Conversely, life insurance is something you might not need. And a lot of people think life insurance is something you're just supposed to get when you get a job or whatever. No, you don't have to have life insurance, okay? So we're going to talk about when it's worth it to buy life insurance and what types of life insurance are available. So let's jump right into it. Let's start with life insurance here. Typically, this is how life insurance works. You make monthly payments and receive a large lump sum payment if you die, okay? So you make monthly payments. We'll talk about how big those monthly payments are, and we'll talk about how big the payment is, okay? But basically, you pay into the system, and then if you die, rather unexpectedly or not, you're going to receive a payment that can go to your beneficiaries, who might be your dependents, your spouse, or whoever else you designate as the person to receive your money, okay? Let's think about when it's needed. Maybe this is the most important part of the video, is to understand that you might not need life insurance. There's two primary reasons why you would need life insurance. One is your income is desperately needed, usually by your dependents, right? So just to give you an extreme example, imagine there's a married couple and only one person in that couple works and they have 5 kids. Well, in that scenario, if that one person who is working were to die, you can see that that could be a financial disaster, right? The spouse may need to try to go back to work. Maybe they don't have the skills that they need to get a decent job. That is like an obvious case where you need life insurance, okay? So you would definitely want to think about who needs your money. Conversely, if you don't have any dependents, you don't really need life insurance. Remember that the company that offers insurance on average makes money off of you, okay? So on average, life insurance is a bad deal. So you probably don't want to put yourself in a situation where you're doing a bad deal when no one really needs your money when you die anyway. If no one is counting on your money now, I would argue you really don't need life insurance, okay? So that's one reason why you might need it. A second reason why you might need it, and this is even if you don't have dependents, okay? So this might be for somebody who's, graduating college, doesn't have any kids or anything. This is the scenario where you might need funds to cover funeral expenses, right? So let's say funerals on average, you're anticipating them to cost $20,000. And maybe you don't have anybody in your family that has a lot of money saved. Well, in that scenario, you might decide to have a really cheap health insurance policy, or rather life insurance policy, in the case that you die, so that someone else is not financially burdened by covering your funeral expenses, okay? You can see that this is generally going to be something that's important for people who haven't earned much money yet. As you gain a little bit of wealth, this is probably not a big deal. For instance, if I were to die right now, I've already have some savings that could be used to pay for my funeral expenses. So this is the two primary reasons why you would need life insurance, okay? And I would say because your friend called you up and works for a company and wants to sell you life insurance, that's not a good reason to buy life insurance. You buy it when you need it and don't let people sell it to you, okay? Because people are really pushy about selling life insurance, right? They'll try to appeal to your emotion. Well, what would happen to you if you died? What would happen? Who would pay for your funeral? Well, think about those things in advance and don't get emotional about it. It's just money, right? It's just money that we're talking about here. So let's make sure we're making good choices. So some considerations before we move on here. And I'm really just trying to set the stage so we have everything we need to talk about this. So some things you need to consider here. Obviously, who needs your income? If you were to die, does anyone need your income? That's sort of referring back to what we talked about with dependents. If someone needs your income, then certainly health insurance or life insurance will seem more necessary to have. But don't just stop there. Don't just say, who might need my income? Also think about what assets do you have? Okay? Not just how much value you have in assets, but what specific types of assets do you have? Do you have $100,000 in a 401k account? Well, then great. That money can usually be used to cover funeral expenses and withdrawn upon your death. Okay? So if you got money in a 401k, great. Let's say instead you own a house. Well, owning a house is nice. Owning a house can be, worth a lot of money to have a house. But the problem is it's hard to liquidate a house, right? It's hard to sell a house. So in that case, even though you might have a lot of money invested in your house, those assets are harder to get to. So that might not be the best thing to leave to your beneficiaries, okay? So think about what assets do you have. If you have $1 million saved up in a 401k, well, I would argue chances are you don't actually need life insurance. What free life insurance do you have? If you are employed, chances are your employer will offer free life insurance. If you were to die, there will be some sort of payment to you already. A lot of times banks do this too. If you have a checking or a savings account, they might offer you a free life insurance policy of maybe $10,000 or $20,000. For me, for example, I'm given $25,000 by the University System of Georgia just as part of my regular insurance benefits. I don't have to pay for it. I don't have to pay anything extra for it, okay? And my bank has a little benefit too. So see what you have available to you already, all right? Look into your employer's HR handbooks and find out how much is available to you without buying any insurance. And then as a fourth and final one, you definitely want to consider your Social Security benefits. And we talked about this in the last series of videos. Social Security essentially acts like a life insurance policy if you've been working for a while. So what that means is as you get older and you work more and more years, chances are your need for life insurance will actually be reduced over time. So if you're 58 years old and you've been working for 35 years, chances are your Social Security benefits are really big. So if you're thinking, I need to leave money to my spouse, you probably don't need life insurance because Social Security is going to provide so much. And also chances are at 58, you've got money in a 401k or something as well. All right, so I just want to show you guys this quote that I took from a book. You might be wondering why I didn't use a textbook for this class. The reason is because they all suck. They're all trash. The textbooks that I found have lots of good information in them, but they also have lots of bad information in them. And if 5% of the information in a book is faulty in some way, well then I can't really use it, right? So I've just been very disappointed with the available books that are out there. And so one of the books, for example, provided this statement: life insurance is part of every successful financial plan. Why the hell would it be part of every successful financial plan? Let's say I've won the lottery and I have $40 million sitting in a bank. Why would I need life insurance, right? There's no reason for me to have life insurance. If I were to die, my dependents would get my $40 million. Right? That's kind of a ridiculous example, but let's think about another one. Let's say that if I die, I've got Social Security benefits coming in of $60 grand a year, and I've got $500,000 in a 401k. Well, in that scenario, again, you might not need life insurance. And third, what if you never get married and you never have a kid? Why would you need life insurance, right? There's no reason to get life insurance in these circumstances, because no one desperately needs your money. So I just think this is patently false, all right? Life insurance is definitely not part of every financial plan, and that's my quote, okay? So I want to make sure that I'm emphasizing this, because so many people will tell you you've got to have life insurance. It's an easy thing to say. You should have life insurance. You definitely should have it, right? But the problem is it doesn't really fit. And the better you are at personal finance, the more skills you have, the more reason there is to not get life insurance. Because the more skills you have, the more likely you are to figure out good ways to invest your money. And if you're investing money at a high rate of return and saving a lot of money, maybe you don't ever need life insurance, okay? For me, I have just a tiny, tiny bit of life insurance. We'll talk about that in a bit. But I almost made it my whole life without any. Had kids just a little too early to get to the point where I had enough wealth to avoid life insurance. But certainly if you don't have kids or a spouse, you don't need life insurance. Okay. So, two types of life insurance. All right. When I say you don't need life insurance, that's different from me saying that you don't want life insurance. Okay. Need and wants are different things. So even if you don't need life insurance, you may choose that you want it just to make you feel better. That's fine. Okay. Two types of life insurance. There's actually more than two types of life insurance out there. There's a lot of different versions, but there's two primary types that are offered. So I'm going to talk about these. The first is term life insurance. I have term life insurance, and it's offered through my employer. A lot of times it is. A lot of times term life insurance can be purchased through your health insurance system that's offered through your business, okay? So a lot of times it's lumped together with offerings from health insurance. But that being said, you can buy life insurance everywhere, all right? Life insurance is offered by lots of different companies, so it doesn't have to be tied to your employer. Okay, term life insurance. Term life insurance is coverage for death that is provided for a period of time, or term, right? That's where term comes from. Term life insurance does not mean that you're going to have life insurance forever. It means you're going to have life insurance up to some point in time, okay? So for example, if you set up life insurance, term life insurance with your health insurance system that's offered by your employer, chances are that term life insurance will be offered for 1 year, which means you're going to make payments every month for a year, and then at the end of the year, you'll have the chance to decide, do you want to still have that term life insurance? If you don't, your insurance goes away, okay? So it's available until the term ends. So this might be for 1 year, it might be for 10 years, or whatever, all right? There's lots of different term insurance policies out there, okay? The main advantage of this is that it's cheap and flexible. Term life insurance is really cheap most of the time. So let's say, for example, that you feel like you need $500,000 in coverage. When you die, you would like to have $500,000 given to your beneficiaries. Well, chances are it's going to be pretty cheap to do that. You know, maybe only something like $50 a month to provide that benefit. All right, so pretty cheap. The reason to be pretty cheap is, let's say you get this insurance right when you get your first job and you're 23 years old. Well, you have a very low likelihood that you're going to die. So life insurance is going to be cheap. And because it's only for a period of time, there's no guarantee that you will die during the term, okay? So most term life insurance policies never pay out, because in most cases you don't die during the term. That's why it's so cheap, because chances are you're just paying in without getting any money in return. but that's okay, right? If it's worth it to you to make those payments, it's nice because it's cheap and it's also flexible. The fact that the term ends is bad in a way, right? It's bad because you're no longer covered. But what it means also is you can decide to get a 10-year term life insurance and not be obligated to continue paying after that 10-year period. So it provides flexibility. I've got a 1-year term life insurance plan. If I decide I don't want it next year, I can just quit, right? I can stop making payments on it. So it doesn't box me in to making payments for the rest of my life like you'll see with the other key type of life insurance plan, whole life insurance. The main disadvantages are obviously that it ends, right? And the fact that it ends means you may never actually get any payments from your term life insurance plan. I sure as hell hope that I don't get any payments out of my 1-year term life insurance plan. So it ends, and there's a good chance you don't ever get any payments from it. Renewing may become challenging over time. As you get older, your risk of death rise. So that $50 a month that you're paying when you're 23, that might not be an option when you're 43 years old. So getting term life insurance may be a challenge in the future, okay? For that reason, term life insurance is best for people who know that they're not going to have it forever. So my thinking is, just 3 or 4 years from now, I'm not going to really need life insurance anymore. So at that point, I'll just stop making these life insurance payments, okay? Best for me because I'm not boxed in and I don't so much mind that it ends because I don't need it 20 years from now. So renewing may become challenging over time, which is a disadvantage if you're somebody who would like to be covered for the rest of your life. And lastly, it has no value until you die, which is going to be different from the other type of plan that we're going to talk about. All right, so trying to kind of compare between the two plans, but we haven't seen whole life insurance yet. But the term life insurance doesn't give you any value unless you die. So that means if you've been paying in thousands of dollars, over the last 10 years, and then your insurance ends, it's like you paid in without ever getting any sort of tangible reward from it. Okay? So that's term life insurance. Let's just think a little bit about life planning here in regards to term life insurance. By the way, this is probably the policy type that you're going to use. This is the most popular policy type, and it's also the one that personal finance experts usually recommend. Okay, so there's a good chance you're going to be using this type of system. So let's think about life planning. Let's say at age 30, you have 2 kids and a net worth of $100,000. Okay, like a lot of people would fit this category, right? So at age 30, maybe you've got 2 very young kids. You've got net worth of $100,000. You got 30 grand in a 401k, 20 grand in a Roth IRA, and $50,000 in a savings account or something, just for example. Okay, maybe in a home equity perhaps. In this scenario, you could sort of imagine why life insurance would be really important. All right, life insurance is probably going to be important here because these assets are not adequate to pay for your kids' needs right now. Right? If you are married in this situation and you're both supporting your kids, well, maybe just one salary is not going to cut it. So in this scenario, I would argue having life insurance is very important. Okay? In this scenario, you really do indeed need life insurance, most likely. Okay? And probably term life insurance is going to be a reasonable option for this person because, this person, they're clearly on the right track in terms of saving money, which means in the future, they may be in a situation where they don't so much need life insurance. So indeed, let's think about this same person now, age 50, they now have 2 adult kids, who are probably in college or entering the workforce, and now their net worth is $800,000, okay? Think about it now. This person here, I would argue, probably, no way to know for sure, but they probably don't need life insurance. They may choose to get life insurance, but it's probably not a necessity at this point in time. Because if they were to die, they would have $800,000 given to their kids. And also remember that Social Security benefits are a function of how many years you work and how much you earn. Remember we talked about the average index monthly earnings, right? And those survivorship benefits. Well, if this person has been working for 25 years, when they die, a significant amount of value is going to be provided to their spouse once their spouse hits age 62. And certainly that's going to reduce the need for life insurance now. So for a lot of reasons, this person at age 50 might not need insurance, right? One, they're financially stable, they have a lot of savings. Two, Social Security is going to kick in pretty soon. And three, their kids are now adults. So you can sort of see why term life insurance might be good for somebody like this. And this person I'm talking about is you, right? This is like the typical person in this class will end up getting married, have a couple of kids, and by the time they hit 50, they've got a decent amount saved up, okay? So you can sort of imagine why term life insurance would be nice, because if you decide you don't want insurance anymore, well, with term life insurance, just stop buying it. Just stop paying for it. All right. So let me give you a couple of notes here about term life insurance that we haven't specifically or explicitly covered yet. One thing to remember is it's usually offered by your employer. It'll be usually packaged into your health insurance options, but it's also offered privately as well. So if you decide you want life insurance, you often have a couple of very obvious options. One, see what your employer is offering, and two, see what's offered by various private companies, right? Various insurance companies, you know, Aflac, for example, I'm sure they offer life insurance, okay? So you might see what's available out there. Another nice thing about life insurance is that the benefits are tax advantaged. So what I mean by that is if I were to die right now, my term life insurance that I was discussing before, my term life insurance benefits would not be taxable. So that $95,000 I've paid for in terms of benefits, if I were to die right now, $95,000 would go to my wife. That wouldn't be taxed. Okay, so another nice thing just to recognize that the benefits here are really tax advantage, which is definitely a benefit because as we know, as we've seen in various examples, earned income is usually taxed at a very high rate. All right, so not so bad. Okay, so that's term life insurance. One more thing for me to show you just before we move on, just to give you an actual data point of what this looks like. For me, I'm offered $25,000 in free term life insurance. As I mentioned before, you often get some sort of insurance from your employer and often also from your bank, actually. So for me, I get $25,000 right away. So that'd be good for covering funeral expenses or whatever. Always nice to have that. And I actually decided to buy some additional term life insurance. So I pay, how much do I pay? Just $8 a month, actually, for $95,000 of term life insurance. And that's all I have because I've done the math. That's all I really need. I've already got some assets available. I've got, death benefits for Social Security. So I just pay $8 a month to get this extra benefit here. My logic was if my wife took this money, she could pay off the house. The rest of the money we owe on our house, and then she wouldn't have any debt. So that was my logic. Mathematically, I'm not sure that's super sound, but it helps me sleep at night to know that I've got this extra benefit here. Okay, and $8 a month, obviously not a huge amount of money. Term life insurance, and if you're wondering why it's so cheap, well, I'm very unlikely to die, right? At 34 years old, I'm very unlikely to die. So it's cheap for the insurer to insure people like myself. Okay, so that's term life insurance. Now we can move on to whole life insurance. From my experience, whole life insurance is the type of insurance that you get cold called about and offered to purchase. I've actually received 3 emails from prior students in the last 2 weeks asking about whole life insurance because someone had been calling them trying to get them to buy it. Whole life insurance usually is very profitable for the insurance companies, but that doesn't necessarily mean it's not a good idea for you to have. Chances are you won't use it, but chances are somebody in your family right now does have it. So I want to explain how it works. This is the big difference here is it's permanent life insurance. You carry this for your Whole life, that's where that comes from. Your whole life you'll carry this life insurance. So it's permanent life insurance. Covers a whole life for many years of payments. Those payments are usually fixed over time. So for whole life insurance, you might be paying $100 a month for your entire life, which is expensive, but the benefits can also actually be pretty big. All right. So you might be paying $100 for your entire life. Sometimes they're set up where there's a period where you might only pay in for 25 years, but the benefits are always whole life. Okay. So even if you're paying only for 25 years, you're still covered for the rest of your life on these whole life insurance benefits. Okay. So there's two styles that these might operate under. You might be paying $50 a month until death, or you might be paying, $80 a month for 30 years. Okay. Either way, you're going to be covered for your whole life. It's just different types of systems that exist. Okay. This is actually quite different from term life insurance in terms of how it's handled. Okay. So the big unique feature here is in regards to whole life insurance, the whole life insurance is divided into two groupings of benefits. Okay, there's a death benefit, and then there's also a cash value benefit. Okay, the death benefit is a guaranteed payment. All right, this is kind of like term life insurance. If I had whole life insurance right now and I died, there would be a guaranteed payment that goes to my beneficiaries. So for example, that might be like $100,000 at death. And that part is guaranteed, okay? But also there may also be a cash value. And if you live long enough, there definitely will be a cash value. And this is funds that are invested. Right? Very different from term life insurance. There's no investments in term life insurance. You're just paying for service. In this case, your money actually gets held in kind of like an investment bucket and invested in stocks and bonds and such. And so the funds are invested and grow over time. So if you live to, say, 90 years old, you might find that you got $1 million in your cash value. And when you die, not only will your beneficiary get the $100,000, they'll also get the additional funds that are in the cash value. Okay? So what this means is the types of benefits you get are going to be dependent on the age at which you die. So for example, with early death, let's say you die early, and this is the scenario that you have. You have cash value of $10,000, and you have a death benefit of $100,000. All right, first we need to ask ourselves where these values come from. The death benefit is the guaranteed payment upon death. That's just set in the terms of the insurance policy that you have. Okay. The cash value is based on how much you've put in and how much your investments have grown over time. All right. So you've been making those, $50 or $100 monthly payments. They've been invested. You've now built up to $10,000. All right. If you die right now, in this scenario here, the death benefit would be $100,000, and that would be the entirety of it. In fact, this insurance company would lose money off of your insurance policy. Okay. In this scenario, the health insurance or the life insurance company would keep the $10,000 and then pay out $100,000 to your beneficiaries, thus effectively losing $90,000 in value. Okay. So if you've only been paying in for a short period of time, that's how it works. On the other hand, if you have a late death, things may be quite different. In this situation, your cash value might be, $800,000, and your death benefit is still just that set $100,000. Okay? In this scenario here, you would actually have a death benefit of $100,000 plus $700,000 in that extra cash value fund. Kind of think about it this way. The insurance company has $800,000 of your money that they're holding. They give $100,000 because that's what was promised. And then there's still $700,000 left over. Okay? So this is the second option, and this is what's going to be most common because people tend to die later in life, right? So what's nice about the whole life insurance plan is that cash value. So if you live to be 100, it's not like you were just pouring money into a term life insurance plan without ever receiving any sort of benefit. No, your money will be invested and grow over time. So what's the downside, right? This sounds pretty good. Well, imagine the types of expense ratios that you're going to see in these investments. Usually, what the insurance companies provide in terms of investment options are largely outside of your control, all right? You might be able to tell them I'd like less risk or more risk. You might be able to tell them you want to invest in index funds instead of mutual funds, but you're not going to have a significant amount of control over what happens. And a lot of times these insurance companies have very strange policies. There's one going around right now where the yearly returns cannot go above 12%. They also can't go below 0%. All right, so if the stock market goes up 30% and you're invested totally in the stock market, you get a 12% return. If the stock market loses 10%, you get a 0% return. Okay, that might sound okay, but it's not. Mathematically, that's a bad deal for you. So there's all kinds of strange ways this money is invested. So for somebody like you or me who's good at this stuff, that makes this a worse deal because we know how to invest our money. So we don't need somebody to be investing our money in a bad way because every dollar that we have right now, we are very good at investing. Okay, so whole life insurance generally is a bad deal for people who are good at personal finance strategies. All right. Nonetheless, that cash value, a big benefit. All right, so remember that cash value. This is that money invested. Okay, I just want to make sure we understand how this cash value works. When you die, that money will be given to your beneficiaries with no taxes attached to it. Usually, all right, which is a really nice deal. So if you got $2 million in cash value, it just goes to your beneficiaries. Usually there's not any taxes attached to that, okay? However, you can usually withdraw from your cash value when you're older. Okay, you can use your cash value you can basically take money from your cash value and just spend it however you want, as long as you're a certain age, as long as you reach the qualifications. You can even use the cash value to make your monthly payments to itself, okay? However, any gains are taxed as income. And when people try to sell these whole life insurance policies, that's the sort of thing that people like you and I understand and other people don't, okay? So they look at this policy and they say, oh, well, this is great. My money gets invested. Well, the investments usually suck, so that's not so good. And I can withdraw from the money. That's good. Yeah, but your gains are taxed as income. Remember, if we have gains in a 401k that are growing over time, we don't pay income taxes on that until we withdraw from it, okay? We only pay income taxes once. But in the case of life insurance, you're going to pay income taxes when the money's going in most of the time, when you earn it, and then income taxes again on the gains. Not a good deal. Okay, that's not always true, but it usually is if you use a private employer or a private insurance company to buy whole life insurance from. The money you use to pay for life insurance has already paid income taxes, right? That $100 a month in payments, you already paid all of the taxes, right? You've already paid income taxes for federal, state, Medicare, and Social Security. And then any gains you receive when you withdraw it, you're going to pay income taxes again. That's a bad deal, right? If it was in a taxable account, you'd only pay capital gains. That's even better than this. All right, so this is not such a good deal. But at least it gives you flexibility if you need the money for something. All right, so it's not all bad. That being said, it is tax advantaged at death. So it ends up operating very similarly to like a Roth 401k or a Roth IRA because the money doesn't get taxed at death if you never pull from these funds. Okay, so it's okay here. In this scenario, it's all right. But if you have to withdraw from it, it's not such a good deal. And I'm making such an emphasis on it because people push this as being like a huge benefit. And it's not really a huge benefit because the taxes are just so negative. The taxes are just such a problem in this example. All right, so just to summarize what we've talked about here, for our whole life insurance, still talking about whole life insurance, I just want to make sure we understand the benefits and the costs. So the advantages of this account, really, maybe the biggest one is it provides forced savings for people who otherwise wouldn't save much money. If you try to get out of your whole life insurance plan, you usually can't, all right? Or if you do, it's something called surrendering. You can surrender your life insurance plan, but it's really a bad deal. So what's good about this whole life insurance plan is it's forced savings. So if you know somebody who's kind of irresponsible, they earn a lot of money, but they're not good at saving it, you might recommend whole life insurance because it forces them to save, and they won't be able to access the money until the cash value becomes available much later in life. So this is good in some regards. For me and you, it's bad because it's forcing us to save money when we're actually good at saving money on our own. We don't need that forced savings. We're already good at putting money in our 401ks and 457bs. All right, so that can be an advantage depending on your situation. It's tax advantaged at death, which is good. Specifically, you don't pay any taxes when it's withdrawn. All right, so that's a good deal. And that cash value and investment can be a benefit. Again, I don't see that as such a benefit to me because I already know how to invest my money, right? But for people who don't, it gives them a way to force them to save and invest their money. That being said, the disadvantages. One, it's expensive, both in terms of how much you pay, but also in terms of the benefits. Remember, insurance companies, they're worth billions of dollars. They make billions of dollars off of these policies. So don't think you're going to find some sort of special loophole where you get to take advantage of the plan. No. Chances are you're going to lose money on any insurance plan you have because the other side is making a profit. So it's expensive, all right? If you can put your money into a 401k instead, that's more value in the future to you than having it into a life insurance plan because chances are health insurance plans and life insurance plans are a bad deal, right? It's inflexible. If I want to withdraw money from a Roth IRA, easy, right? If I want to withdraw money from my life insurance, whole life insurance plan, not easy. And I'm going to get taxed to hell, okay? So it's inflexible. It's hard to withdraw from. It's hard to change the way your plan works. And it's not invested very well, okay? Most of the time, the investments are not what you would like, and they charge fees. They rope you into these weird investment decisions. So it's not as good as what you would do investing your money. So I just want to make sure we understand the choice that we have. And I'm just going to close this off by thinking about you as somebody who's good at personal finance. So I'm going to say that this is you over here. And this is some idiot over here. All right. And when I say idiot, I mean like 90% of people who don't know how this stuff works. This is me like 3 years ago. I didn't know what I was doing. All right. Hopefully you guys are going to be way ahead of where I was, which is going to put you on a path to retire earlier or be much wealthier when you're older. I wish I could have taken this class when I was young. All right. So this is you, good at personal finance. This is your common American, doesn't really understand personal finance at all. And let's say that each of these people is holding a $100 bill. Okay? Think about what these people are going to do with their money by default. Okay? This person, first of all, is going to be way more likely to spend that $100 bill because they don't understand the power of investing and saving and compounding interest, right? So they're more likely to spend it. But let's just imagine they both save it. Okay? Where's this person probably going to save this money? They're probably going to put it in a bank. They're going to put it in a checking account or a savings account or something and get very low interest rate and be taxed highly. Savings accounts are terrible, right? Interest rates are low. They're taxed. Your benefits are taxed as income on it. Not good, okay? Versus you, the smart person, when you save this money, you might put it into a Roth IRA or an HSA or something very beneficial. So what you should recognize right away is this $100 is worth more to you than it is this person, right? To you, this $100,000 is $1,000 20 years from now. To this person, $100 now is like $200 20 years from now. So your $100 is worth more, okay? So you could instead put it into whole life, right? You could decide that that $100 a month goes into whole life insurance. Well, for you or the idiot, the benefits are going to be the same to putting it into whole life. But the problem is the opportunity cost is higher for you, right? You have a very good choice of what to do with your $100. So if you put it into whole life, not a good choice. This person has a terrible place to save their $100. So by comparison, maybe whole life is a good decision, right? Whole life in general is not that good. But if your other option is crap, well, then whole life insurance suddenly seems okay. So this is my thought on whole life insurance. For people like us that are good in personal finance, don't do it. But if your crazy uncle who doesn't save any money, who doesn't know what to do with personal finance, tells you they want to buy whole life insurance, you say, go right ahead. Because chances are they're either going to spend or poorly save that money that goes into the whole life insurance. All right. So all of this connected just to say life insurance, something you may or may not need. You should think about it. Don't just buy it arbitrarily because you think that's what you're supposed to do. Buy it if you need it. Probably if you're good at personal finance, look for term life insurance. See what your employer offers first, and then also compare that to what the private market offers. If you know that you're the type of person who spends that every dollar that comes in and has trouble saving, well, then maybe consider whole life insurance.